Hello traders, welcome back to the Forex Gig where we dive deep into the tools that can be used to help make smarter trading decisions. In today's video, we are going to be talking about the powerful W and M Forex trading strategy patterns. These patterns are essential for identifying potential market reversals and can significantly enhance your trading strategy. By understanding how this pattern forms and how to effectively trade them, you can gain an edge in the forex market. Now stay with me until the end of this video so you could learn how to spot this pattern, determine the entry and exit points, and manage your risks effectively. So let's get started. Understanding the W and M pattern. To become proficient in forex trading, it is crucial to understand the W and M pattern, which are fundamental tools in technical analysis. This pattern help to identify the potential reversals in the market, offering opportunities for strategic trades. The W pattern, also known as the double bottom, appears after a downtrend and signals a potential bullish reversal. We can recognize this pattern by its distinct shape, two double bottoms separated by a peak. The second bottom should not fall below the first, indicating that there was a downward momentum, and the downward momentum is weakening. When you spot this pattern, it suggests that buyers are gaining strength, potentially driving price upward, which happened from the example on the screen. On the other hand, the M pattern, or should we say the double top, forms after an uptrend and indicates a potential reversal. This pattern consists of two peaks separated by a dip, as you can see from the example on the screen. Observe how price creates two highest points with a dip in between them. The structure signals that selling pressure might be coming in increasingly, leading to the decline in price. Understand this pattern is vital for making informed trading decisions by recognizing the W and M formation on your chart. You can better predict the market reversal and adjust your strategies accordingly. Now let's look at how we can enter a trade using this pattern, on how we can trade using this pattern. Now from the example, you notice that that price broke the midpoint of this pattern. The midpoint, if you can see the W, price broke the midpoint. This is the pattern here. Price broke this midpoint, and once price breaks the midpoint, it is an indication that strong bullish pressure is coming into the market. Whereas for the M pattern strategy, once price break the dip of this pattern, the low in this pattern, it is a signal that bearish strength is coming into the market. So let's see how we can take trades using this example. Now for the W pattern, remember I said is when the price breaks this particular low, the midpoint that you should enter your trade. So when you see price has broken this area of the market, you take your buy tool, your long tool, and enter the trade. don't forget to put your stop loss slightly below the lower low, or slightly below the double bottom. Then your profit target should be, you can target 1:1, you can target 1:2, you can target a fixed point, you can target a previous high or a previous low, and it should be at a distance matching the pattern's height. That is, if the pattern's height is this, you can make your stop loss equal to your take profit, to make it a 1:1, to be on a safer side. Now, there are key points I would like you to note for both patterns. First of all, before taking any of this trade, you can confirm your trade with a volume analysis, or you can look for the pattern that forms over several price bar rather than a quick fluctuation. In the sense of, you can take the pattern when you see price has tested an area. Let's assume this is a support, a resistance rather. The fact that price has been testing this area shows that here is a strong area where buying pressure wants to come in. That's what he's trying to say. You also need to pay attention to the general market trend before taking such trade entries. As you can see, I'm trying to take a double bottom, and the price trend of this market is trending to the upside, which shows that yes, there is buying pressure in the market, as you can see. So when we want to confirm this entry using the volume analysis, let's not forget that we have our volume tool over here, which is this tool here. If you can notice, when price broke the midway point of the double bottom, we notice a spike in the volume bar. This shows that yes, buying pressure came into the market. This is what it shows, that there was enough buying pressure in the market. Now let's take an example for a bearish or double bottom pattern, double top pattern. Now the double top, we are meant to buy when price has broken the midway point of the M. This is the M pattern, as you can see. This is the M pattern. Now we enter the trade, the short position, when price break such area, and don't forget your stop loss should be above the double top. Your take profit can be equal to the length of the area where price moved from the double top to the midway point, or you can target a fixed risk to reward ratio like 1:2 or 1:3, any one of your choosing. So this is the best way, this is the beauty of this pattern, which lies in this clear structure, which helps you maintain discipline in your trading approach. By following these entry and exit rules strictly, you can develop a consistent trading strategy. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and share, and turn up your notification bell so that you won't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.